Hello friends, welcome back. Let's start with our first case study of CA final paper 4 law case scenarios. The question says WRPC Limited is a Mumbai based company in which the central government holds 35% of share capital, while the governments of Maharashtra and Karnataka holds 15% and 10% of share capital respectively. WRPC manufactures corrosion resistant overhead transmission and distribution products. The internal auditors of company had raised serious concerns in respect of the certain internal control irregularities. During the year 2018 to 2019, WRPC was also defaulted in complying with the statutory requirements pertaining to full filing of its financial statements under Section 137 and notice from the and annual written under Section 92. Consequently, company received a notice from the Registrar of Companies, Mumbai, Maharashtra, to rectify the fault. So till here, we notice that WRPC is a government company and it has defaulted in filing its financial statements under Section 137 and annual return under Section 92. Okay, moving on to the further. The company was also served show cause notice by the revenue officials on certain GST and income tax related issues. The board of directors of WRPC consisted of 14 directors. Due to the increased volume of business, alleged internal control irregularities, and lack of professional skills needed for the statutory compliances, the company felt the necessity of inclusion of some senior professionals on its board. Accordingly, it was thought of inducting Ranjan, a chartered accountant, and Sanjay, a company secretary, as the executive directors. So it has 14 directors already. It wants to appoint two more directors, Ranjan and Sanjay. Which company? WRPC, which is a government company. Okay. Next, moving on to the further. Circuit Board Private Limited, CBPL, a Delhi-based company, and Pisco Electronics Limited, a Pune-based company, are the two major components suppliers to WRPC. CBPL is a family-managed business with 57 shareholders, and Pisco Electronics is yet to be listed, but in the near future, it tends to get listed. As per the audited financial statements, the paid-up capital and the turnover of CBPL and Pisco Electronics were as under. So you are being given with the paid up share capital and turnover of both the companies for the year ending 2019 and for the year ending 2020. Okay, Pisco had 4 directors as on, CBPL has 4 directors as on 31st of March 2019 and 5 directors as of 31st of March 2020. In case of Pisco Electronics, there were 7 directors as on 31st of March 2019 and 6 as of 31st March 2020. However, none of the companies had appointed any woman director during these 2 years. Ajay Prakash is the chairman and the managing director of CBPL. Considering his old age and other health-related issues, he wants to retire from the company. Accordingly, he discussed the matter in the board meeting and also proposed to explore the possibilities of appointing his eldest son Pranav Prakash, who is an MBA graduate from FMS University of Delhi, as a managing director of a company for a period of 10 years from 1st of January 2021 onwards. The board meetings of Pisco Electronics were convened 5 times during the calendar year 2019. No board meeting was held in January or February 2020, but thereafter 6 board meetings were held during the remaining part of the calendar year 2020. Vasuki is one of the executive directors appointed by the Pisco Electronics. He had taken a loan of 70 lakhs from the company on 1st of January 2019 after fulfilling the required formalities. The terms and conditions on which the loan was granted specified that Vasuki shall repay the principal amount in 5 years. That is, 20 quarterly installments of equal amounts, and the interest at the rate of 9% per annum to be charged at monthly rest on the reducing balance shall also be paid as and when they are due. However, due to the changed economic scenario during 2020, there was a drastic reduction in the normal borrowing rates. Accordingly, Vasuki requested the company for change in his borrowing terms, that is, to reduce the interest rate to 8% per annum from the existing 9% per annum, and to increase the period of repayment from the present 20 installments to 30 installments. So this was our question. This was our case scenario. Now let's look at the multiple choice question. The first question states, from the case scenario, it is observed that WRPC had 14 directors, but due to the increased volume of business, alleged internal control irregularities and professional skills, etc., required for statutory compliances, the company intends to induct Ranjan, a chartered accountant, and Sanjay, a company secretary, as the executive directors. Which of the following options is best suited to such a situation? Now let's look at the provision of the maximum number of directors that a company can hold in case of a government company, and what would be the conditions for the exceptions as well. So here comes the provision with respect to the number of directors in a company. So the maximum states it was 15 directors. More directors can be appointed by passing a special resolution. Okay, but there are certain exemptions to it. A government company is exempted from the application of Section 149, subsection 1, clause B, which requires a company to have a maximum of 15 directors only, and from the application of first proviso to Section 149, subsection 1, which enables a company to appoint more than 15 directors after passing a special resolution. So these two things would be exempted in case of a government company. However, above exception is applicable only if such government company has not committed a default in filing its financial statements under Section 137 or annual return under Section 92 with the registrar. So in the current case, WRPC has violated these two sections, Section 92 and Section 137. So it has defaulted filing statements, financial statements under Section 137 and the annual return under Section 92. Henceforth, this exemption is not applicable to WRPC Limited, even though it is a government company. Now let's look at the options given and we'll decide the final answer. And in case, let us suppose a WRPC has to appoint more than 15 directors, in such case it has to follow the regular provisions, that is by passing a special resolution. Okay, now let's look at the options once. So the first option states WRPC could appoint either Ranjan or Sanjay as executive directors because in case of no statutory because in no case a statutory limit of 15 directors was to be crossed. Is that the case? In no case are we not supposed to appoint more than 15 directors? No. You can appoint more than 15 directors by passing a special resolution. Henceforth, option A is incorrect. Option B states WRPC increase the total number of directors to 16 by passing an ordinary resolution in the general meeting of shareholders with a view to appoint both Sanjay and Ranjan. Is that so? No, we have to pass a special resolution. So option B is ruled out. Option C states WRPC increase the total number of directors to 16 by passing a special resolution in the general meeting of shareholders with a view to appoint both Ranjan and Sanjay. So option C is the correct option. We'll move on to the next option to see why it is not correct. Being a government company, since WRPC is exempt from passing a special resolution in the general meeting of shareholders for increasing the number of directors to 16, it increased the total number of directors to 16 from the existing 14 without passing a general resolution and appointed both Ranjan and Sanjay. Ideally, this should be the case, but in the current case, the company has defaulted filing of financial statements under Section 137 and the annual return under Section 92. Henceforth, it is not eligible for this exemption. Therefore, option D is also incorrect. Now we'll move on to the next question. From the case scenario, it is noticed that none of the companies had appointed any woman director, though CBPL had 4 directors as on 31st of March 2019, 5 as of 31st of 2020. And BISCO had 7 directors as of 31st of March 2019 and 6 as of 2020. Which of the following option is applicable in the given scenario? So the question is about appointing an woman director Now let's look at the provision as to what exactly is the limits of the paid up share capital in the turnover of a company to appoint a woman director. So the provision states like this: at least one woman director shall be on the board of such class or classes of companies as may be prescribed under Rule 3 of the Companies Appointment and Qualification of Directors Rules 2014, which is our second proviso to Section 149 subsection 1. So what does the rule state? So Rule 3 provides that the following class of companies shall appoint at least one woman director: every listed company and every other public company having a paid up share capital of 100 crores or more, or turnover of 300 crores or more, either of these. Okay, either paid up share capital to be more than 100 or turnover more than 300 in case of other public companies. But if it's a listed company, it has to have a woman director. Now let's look at the paid up share capital and the turnover of both the companies, and we'll decide the answer. So looking at the question, let's see, CBPL is a Delhi based company and it's a family managed company. Okay, so CBPL stands for Circuit Board Private Limited. It's a private limited company. And Pisco Electronics Limited, it's a limited company which is a listed company, but it states, the question clearly states, it's about to be listed. And the paid up share capitals were being given here. Now let's go step by step. Let's see for the CBPL. So CBPL is a private limited company. Is the provision applicable to a private limited company? The answer is no, because it clearly states listed company and every other public company. But looking at the question, it is a clear private limited company. Henceforth, even if it crosses the limits, we are not supposed to include a woman director in the board of directors. So CBPL is straight away ruled out. Pisco Electronics Limited it is about to be listed, so it's a public company basically. So looking at 2019 paid up share capital, it was 50 and the turnover is 275. So it's not exceeding any of the limits of paid up share capital or turnover, because the paid up share capital limit is 100 and the turnover limit is 300. So 2019 it is not exceeding the limits. So now let's look at the Pisco Electronics for 2020. So the paid up share capital is 15 again, but the turnover here is 305, which means it's exceeding the turnover limit of 300, and the statements and the provision states either turnover 300 or paid up share capital 50 crore. Henceforth, Pisco Electronics Limited must have an woman director for the year ending 2020. Now let's look at the options. So here you go. Option A states CBPL should appoint at least one woman director based on the audited financial statements as on 31st of March 2019. And we have just seen CBPL is a private limited company. Henceforth, this mandatory woman director provision is not applicable to it. Now let's move on to the next option. Pisco Electronics should appoint at least one woman director based on the audited financial statements as on 2019. So as on 2019, it is not exceeding any of the turnover of the paid up share capital. Henceforth, even this option is incorrect. Now we'll move on to option C. Pisco Electronics Limited should appoint at least one woman director based on the audited financial statements as on 2020. Yes, this option is correct, because in 2020 the share capital is still 50. However, the turnover is exceeding 300, which stands at 305. Henceforth, option C is the correct option. Option D again states CBPL should appoint at least one woman director. CBPL is a private limited company. Henceforth, to have a mandatory woman director is not applicable to the private limited company. We'll move on to the next question. Which of the following whole-time key managerial personnel, both CBPL and Pisco Electronics, are mandatorily required to appoint? So now let's look at the provision of whole-time key managerial personnel, whole-time KMP, and then we'll come back to the options. So here comes our whole-time KMP's provision from our ICM material, which states MDCU or manager, any of them, in the absence of the above, we should have a whole-time director. And then we have company secretary followed by CFO. Okay. Now looking at the provision, according to Rule 8 of the following companies should have a whole-time KMP. So which were those companies? Every listed company and every other public company having a paid up share capital of 10 crore rupees or more. Requirement of company secretary in certain other companies. According to Rule 8A, every private limited company which has a paid up share capital of 10 crore rupees or more shall have a whole time company secretary. Okay, in other words, it is now mandatory for every private company to have a whole time company secretary if it is a paid up share capital, if its paid up share capital is 10 crore rupees or more. So, irrespective of whichever company you have, you should have a whole time KMP. When it comes to a listed company or any other public company, you can have any of these. But in case of a private limited company, you should mandatorily have a company secretary for sure if the paid up share capital is more than 10 crore rupees or 10 crore rupees or more. Now let's look at our question. So the question states, which of the following whole-time KMPs, both CBPL and Pisco Electronics, are mandatorily required to appoint? So here we should find a common KMP, whole-time KMP, for both a private limited company and other than public limited company, which is our Pisco Limited. Here private limited company is CBPL, other than private public limited company is Pisco Electronics. So let me reframe my statement once. CBPL is a private company and Pisco Electronics is other public companies. Okay, it's a public company. So now we have to come with the solution where we have a common KMP for both a private limited company and an unlisted public company. Now, but before that, let's look at the paid up share capital of both the companies. So looking at the paid up share capital for both the years for both companies, it's exceeding 10 crore rupees. So both companies should have a whole time KMP, and which is common for both the companies is a whole time company secretary. Therefore, option B is the correct option. Even though Pisco Electronic Limited can have any other whole time KMP, but the question is very specific. Both CBPL and Pisco Electronics are mandatorily required to have. So it's asking for a common thing, henceforth option B is the correct option. But if it's asking for Pisco Electronics only, then I can have any of the whole-time KMPs. Looking at the next question now. In view of the changed economic scenario in the country, Vasuki, one of the executive directors of Pisco Electronics, requested the company for change in his borrowing terms. That is, to reduce the interest rate to 8% per annum from the existing 9% per annum, and to increase the period of repayment from the present 20 installments to 30 installments. Which of the following options is applicable in such a situation? Now let's look at a provision where we have interest rate discussion when a loan is being taken by a director. So here comes our provision, point number D. To remit or to give time for the repayment of any debt to the director. Thus, if any debt is repayable by the director, then it cannot be remitted or its repayment time cannot be extended unless consent by passing a special resolution is given by the company. If you want to reduce the interest rate or if you want to extend the repayment period, you should have a special resolution in case if it's a loan repayment by the director. Now let's go back to the question. So looking at the options, the company is permitted to alter the existing terms and conditions relating to the outstanding loan of Vasuki in a duly convened board meeting where all the directors present except Vasuki must consent for the proposal. Is this so? No. It's the requirement of the provision is to pass a special resolution. Henceforth, option A is not correct. We'll move on to the next option. Option B. The company is permitted to alter the terms and conditions relating to the outstanding loan of Vasuki in a duly convened board meeting where the majority of directors present except Vasuki must consent for the approval. Is that so? No. Again, the provision here is to pass a special resolution, henceforth option B is also incorrect. We'll move on to the next option. The company is permitted to alter the terms and conditions relating to the outstanding loan of Vasuki in a duly convened general meeting by passing a special resolution. Yes, this is what we are looking for. And a general meeting by passing a special resolution. Hence, both option C is the correct option. We'll move on to the next option. The company is permitted to alter the terms and conditions relating to the outstanding loan of Vasuki in a duly convened general meeting by passing an ordinary resolution. So it's a straight away no. We need to have a special resolution. So the option is option C. We'll move on to the last question for this case study. Ajay Prakash, the chairman and the managing director of CBPL, desired to retire to his old age and health related issues. Wants to appoint his eldest son Pranav Prakash as the managing director of CBPL for the period of 10 years from 1st of January 2021 onwards. From the following options, choose the correct one. So now let's look at the provision which states the maximum tenure of a managing director that we can appoint in one go. So here comes our tenure provision, which is under section 196 subsection 2. No company shall appoint or reappoint any person as its managing director, full-time director or a manager for a term exceeding 5 years at a time. It is further provided that no reappointment shall be made earlier than 1 year before the expiry of his term. Therefore, the question is stating that appointment is for 10 years, but the provision states you can't appoint for more than 5 years at a time. Let's look at the option and finalize the one. So, looking at the options, option A states Pranav Prakash can be appointed as a managing director for a term not exceeding 5 years at a time. This is what we are looking for, right? You can't appoint a person as a managing director for more than 5 years at a time. So option A is the correct option. But let's look at the other options as well. Option B states Pranav Prakash can be appointed as a managing director for a maximum of 10 years without any restrictions. Is that so? No. There is a restriction. You can't appoint a person for more than 5 years at a time. Option C states Pranav Prakash can be appointed as a managing director for a maximum of 15 years without any restriction. Again, straight away no, because the maximum period at a time is 5 years. Option D states Pranav Prakash can be appointed as a managing director of any period without any restriction, since CBPL is a private company. No. So whether you are a private company, public company, the maximum term for a managing director at a stretch is 5 years at a time. Therefore, option A is the correct option. That's it with this case study. Hope these videos are helpful for you. Please do like, share and subscribe to the channel to get the latest updates. Share it with your friends so that they can have a quick revision of the case studies. Thank you for watching.